So I can get going. Sorry, sneak preview what's coming up. So I'm going to be talking to Adam Norris, who's the new manager of CT Managed Portfolio, in a minute. But first, as usual, some news. So things that I pulled out, Syncona, Bluefield Solar, and then a couple of debt funds who've been raising money. And Syncona first. Now, obviously, this has been a bit of a disaster. We've talked about it before, and we can come on to it in a second, but the discount is extremely wide. The NAV is just sort of gradually coming off there and doesn't pay a dividend, obviously, because it's invested in early stage biotech. And the frustration with the discount meant that in June, the board said, well, we're going to wind the fund up, manage wind down, but to accelerate the process, we're going to create a new unlisted vehicle backed by big professional investors. Retail investors wouldn't be able to switch into it because of the nature of the thing. And it will then buy the assets off the listed vehicle, and then so the listed vehicle can return money, but it'll be doing so at a discount to the NAV, a big discount to the NAV. So they said a small premium to the current share price implied, but like this, and obviously that meant a huge transfer of wealth from retail investors to professional investors. I was upset, a lot of other people were too, and there's quite a big pushback against that plan. So what they've come up with this week is something that's a bit sort of modified that makes a bit more sense. So what they're saying is we're going to hand back £250 million, which is about 41p a share. So to do that, they're going to have to free up some cash. How they're actually going to hand the money back is still to be decided. So they said it might be buybacks, might be tenders. You know, there's a combination of things they could do. Special dividends, even that wouldn't really make sense, but they could do that. But to fund it, they're going to have to sell things, because although they've got cash on hand now, roughly 250 million, they need that to support the existing investments, because these are cash-hungry businesses, and unless they get that cash, they just sort of die, and then you lose all the value you put up so far. So it makes sense for them to keep funding these things, but they do have some stuff in the portfolio that's a bit more mature. So they're saying when it makes sense to sell, we're not going to do any kind of fire sale. We will sell these things and then hand the money back. And then once they've done this £250 million return, then we'll come on to that, but basically they're going to look at what to do next. While this is all going on, they're still obviously putting some of that 250 million cash they've got to support existing investments. They're still making new investments, not huge ones, but up to 5% of NAV can be invested in early stage investments. So they're kind of implying it would be business as usual once they've handed back the money, but they are going to consult on what a new capital allocation policy should be. And here there's going to be quite a diverse opinion, I think, from shareholders. There are some who really wanted the trust to fund things. I mean, the point of it was Battle Against Cancer Trust originally. The whole point of it was to fund new developments, new breakthroughs in cancer treatment, and there's a way of putting money into that cause, and as part of that, it gives money to charity, to a foundation that just helps fund stuff. So there's a lot of people, I think, that would like to see it carry on doing that, but also there's a lot of people who say, well, this is also constructed as an investment, and it ought to be making decent returns, and if it's trading on a massive discount, and there's an opportunity to close that discount, then they should be doing something about it. So I think there's going to be sort of kind of tension there around that, but the board will talk to shareholders about what to do. And it won't be this board. There's going to be a bit of a shake-up because they're recognising that something needs to change on that front too. And they also need to re-incentivise the manager. They're going to cut the donation to charity to 0.25% of the NAV annually. And they're also going to stop buying back stock under the current program, which kind of makes sense because basically we're saying we might buy back stock, but not out of the existing allocation. So they are still planning to launch a private fund. And they're also saying there's a possibility that, again, professional investors will be able to roll their interest into the private fund from the company. That only works if it's for me, it only works if it's done at NAV. So basically, you say these are the assets from NAV, you get NAV for your investment, and you just basically dividend out your share of the assets and roll them into the private fund. That makes that it doesn't dilute anybody. Then they're also looking at maybe spinning out the management company, because they're going to, if they're running two funds, they're saying it would be easier if the management company was separate. I don't think we need to do that. It's not a bad thing often for a trust to own its own management company. You just have to look at something like Linsell Train Investment Trust, where a big chunk of the value is in the owning the management company. I mean, so not that we could create something like this from Syncona, but nevertheless, there is value there, and it definitely cannot be spun out on terms that would be adverse to existing shareholders, and that's something that's really got to be watched quite carefully. We're going to talk about that a bit more when we come to Bluefield, which is next here. There was a question here. So, can a business not fund itself in the current format? Yes, it can fund itself. The issue is there's the massive discounts, so they need to do something about that. This is the best way of doing that. So we'll see. Bluefield Solar, again, massive discount. And steady erosion of the NAV as well, which is something that we've been a bit sort of more unhappy about more recently, because it's just this constant attrition of forecast power prices that we don't know where they're going to end up, and we'd like a bit more information on that if possible. Very attractive yield at the moment, double digit, but there's discussion about it as we'll come on to. So they've announced results for the period to the end of June. Some of this we knew already, because they obviously announce things as we go. The NAV has dropped by 10% over the year. On a total return basis, that works out as minus 3.4, not great. Because the share price narrowed a bit over that period, the discount narrowed a bit over the period, the total return for investors was actually plus 0.4. It's still not, obviously not marvelous, but there we go. And that's widened out again since, so that's disappeared. They're generating enough income to pay the dividend, more than enough, although there was a small hit to the earnings this year. So they fell from 10.6 to 10.4 in terms of what's available distribution. And so that dividend is well covered by earnings. So they paid out 8.9p, and they're targeting 9p for the financial year that we're now in. It's going to be helped by the fact that they're cutting the fee. So the fee will be shifted to be 50-50 market cap and NAV, which a lot of other renewable funds have done now. And the only other thing that sort of pull out the results is that the generation from the wind was disappointing again. It's a big chunk. It's like something like 18% or so below the target. There were problems with some turbines, but there's also a problem with low wind speeds than they're expecting. And we've seen that reflected in adjusting NEVs for lots of other wind generation companies. And I'm starting to think that this whole move into let's have some wind as well as solar was a bit of a mistake. It hasn't really worked since they bought it. So what we've got in the portfolio, you can see there's mostly solar, but some operational onshore wind, and then a whole lot of stuff that's under construction. So some of it is actually being built now, about 25 megawatts, but there's a much bigger chunk which has got planning consent. So over a gigawatt of stuff that's got planning consent but is not being built yet, and they need finance to do that. Plus there's more behind that in planning, plus more behind that in the development pipeline, and they can make that pipeline bigger if they want to. And that's a split between solar and battery storage, so it's not all solar. And where they've got solar, they have pre-sold some of the power through the government's latest subsidy schemes, these auction rounds, ARs. There, so that every year is one. Last year was 6, and the solar price was £61 a megawatt. That's in 2012 prices, so it's actually higher than that if you adjust it for inflation. But actually, they're talking about for auction round 7, which hasn't been announced yet, the results of that. It's going to be lower, about £54 a megawatt. which just shows you that the price of solar is coming down. And this is still the sort of cheapest form of electricity. I know there's a lot of row about renewables and everything else and what they're doing to power prices, but what's driving the power prices up is gas prices, not renewables. Now, they can't fund the pipeline that they've got. It's the similar problem with all the other renewable companies. They did have some cash at the end of the period, but they've already sold that. I've already spent that, which we'll come on to. So the board said something needed to change this time last year. It looked at actually selling the whole company, and they did get quite a long way down the line with that, but then the board pulled out. And what the chairman said is, in that whole process, when they were talking about what they could fetch for the company, they realised that if they owned the manager as well as the assets, they get a higher price in combination. That's what he thinks. And so they're saying, well, maybe it makes sense to knock the two together, which is why I was bringing up with Syncona as well. And the other thing they've said is we're not minded to do buybacks anymore. We set some money aside. We've spent it. That was all spent by the end of January 2025. It didn't make a difference to the discount, so therefore we don't think it's worth doing. And we've got plenty of other things we do with the cash, mainly to fund this new investments. Now, there is a big question mark there about that, because obviously, as from an investment point of view, if you buy back the stock on a more than 30% discount, you get quite a chunk of return from cancelling those shares. So you have to make more than that, really, from making these investments to justify doing that instead. And I think there's a toss-up there, which is up for debate, really. That some shareholders will be unhappy about that suspension of buybacks. So they did spend that cash, as I said. They also raised some cash from doing the deal that they've got with the Pension Fund Consortium, GLAIL, and they used it to buy a chunk of a development pipeline that they didn't already own, that's being developed by the manager, Bluefield Renewable Development. So they've already been buying stuff off the manager already, and they now own this pipeline of stuff which is ready to build, not operational yet. So that's where all the money's gone. So what the board is saying, we've got a choice. We can stick with the existing portfolio, and all of these things from the beginning all the way through, we've always said this, they're set up as kind of annuities. So you build something, it has cash flows that run off for 30, 35, 40 years, but at the end of the day, you're left with a field with a solar panel that probably doesn't work yet still. Yeah, the field is not really worth anything. But you've had all of that income all the way through, and the way the NAVs work, the way everything works, is it's all priced off those future cash flows. We're not talking about some hit we didn't know to the NAV or anything here. This has always been the model. It's kind of like an annuity, so it runs out. And so the only way you keep the whole thing evergreen is to keep investing and keep developing new projects. And they've always tried to do that, using surplus cash flow that they had above and beyond paying for the dividends. But obviously, going down this different route that they're talking about now would need a wholesale revamp of the way the company works. And the thing that's really hit the share price recently is they're saying, well, we'd have to think about the capital structure and what the dividend policy would be. So they're kind of implying that if we go down this route of shifting to a development company that owns the manager, we probably cut the dividend and use the money that we can serve from that to fund the new projects. So that's really what's up for debate here, and that's going to be interesting to see what happens actually over the next few months. Now, just very briefly, CVC income and growth, all these debt funds, since interest rates have been going up, the amounts that they're earning on their investments have been going up too. So they're paying out higher and higher yields, and everything's been quite rosy. They're moving to trading at asset value, And it's one of the sort of bright spots of the sector, really. They're the ones that are trading around. That's why you can see that on that chart there. And they have been issuing stock. So when CVC said we're going to try and do a placing and raise some money, we were sort of quite excited about this because it's not big enough, really. It needs to be a bit bigger than it is to make it sensible. But the amount of money it got was a bit disappointing. So it's a shame, really, that they couldn't get professional investors interested in it, because that's really where the problem is. The retail fundraise was never going to be huge anyway, and you can keep buying stock in the market anyway. So there's a drip of issuance, and they have issued 50 million more sterling shares than we had last year. So it is growing. It's growing at a decent pace, but it's just a shame that we couldn't get that big influx of money in. And part of the problem might have been because it was up against 24 Income Fund trying to do the same thing at the same time. Now, this has a 3-yearly realization opportunity. So this regular exit opportunity that's not too close together, that makes you think about, do I want to be invested in this for the next 3 years or not? This is what we said before about agricultural healthcare and financials and all the other funds that do this. This makes perfect sense, really, is to have these periodic exit opportunities that make you sit down and think, do I want to hold this for the next 5 years or 3 years or wherever long it's going to be? If I don't, I can get out and NAV, and if I do, I'll just hang on. And what the interesting thing around this is with 24 Income, because it's trading at a premium, it has actually got enough sufficient interest not only to place the stock for the things that are people want to get out, but also to raise more money as well. So it actually raised 42 million quid, which is not bad result, really. And good luck to it. And it's actually issued now 63 million quid in the last 8 months. And the last time they did this, they saw a net inflow as well, in 2022. So I think this is just a good example of the way these structures work. And I think it just shows you that if you've got the right marketing effort behind it and you've got a situation where things in demand, they needn't be a sort of, salami slice, losing the fun bit by bit. They can actually be opportunities to grow them. And we've got the next one of these is coming up as public healthcare. I'd love to see that expand. It's just not the right time for people to be cashing in their healthcare investments, I think. But we won't talk about this now. We'll talk about that, I think, next week. So that is enough from me. Let's talk to Adam. Good morning.
Morning, James. Thanks very much for having me on.
Brilliant. So as usual, I'm going to hand over to you and let you tell us a bit about the portfolio. So I'll just give you control of the slides. There we go. And all yours.
Great, thanks, James. Some interesting news there in the investment company sector, and one we keep an eagle eye on as the new portfolio managers of CT Global Managed Portfolio Trust. So I'm Adam Norris. I work with Paul Green. We've worked together over 10 years and primarily focused on third-party manager selection and investment trust selection. So we've been active participants in the investment trust sector for myself 10 years and Paul longer than that. And we're supported by a big team. But before going to the nuts and bolts of the CT Global Managed Portfolio Trust process going forward, just firstly, many of you know Peter Hewitt as the long-term portfolio manager of the CT Global Managed Portfolio Trust. And again, just a big thank you to him for his steward of capital over that time. And myself and Paul, as portfolio managers in the trust, work with a number of different investors across the Columbia Threadneedle, and we're part of the CT multi-asset EMEA team, which is led by Paul Niven. Many will know him as the fund manager for F&C Investment Trust. We manage multi-asset portfolios, multi-manager portfolios, and many different types of strategies, but really challenging each other's view on asset allocation and market positioning. We also work with another team in the manager research team. It's led by David Weiss, who's based out in Boston, but with investors based in London, Netherlands, Boston, and Minneapolis. And all of these coming together for the benefit of the CT Global Managed Portfolio Trust. And thought I'd give an intro to the different pillars that can help drive performance and trust selection going forward. But just taking a step back as to what makes the CT Global Managed Portfolio Trust unique in the investment trust structure, it has quite two sets of portfolios with clear and separate objectives. So we have the growth portfolio, which is focused on NAV growth and capital growth over the long term, medium term, but also the income portfolio. And the income portfolio is there to generate income for investors, but also total return and grow that income over time. And it's aimed to be a long-term savings vehicle for private individuals with a large portion of the shareholder register as part of the CT savings scheme. And what makes it unique? There's two real defining features of it. The income that's generated in the growth portfolio, so this may be from global income or UK income trusts which are held in the growth portfolio. Well, that income is transferred over to the income portfolio, which boosts the dividend yield or dividends available within the income portfolio, but the corresponding level of capital is transferred back to the growth portfolio, boosting the capital available for the growth shares. And that's unique in the investment trust sector. And then once a year, there's a conversion facility, which is currently underway for its annual process, where investors who are in either of the portfolios, so say you're in the growth portfolio and you've been in the growth portfolio for 10, 15 years and the capital's grown, and now you want income, well, you can switch annually from the growth portfolio to the income portfolio and vice versa. And why is that important? Well, in this lower CGT threshold era that we're currently in, it's not treated as a disposal for capital gains tax purposes, and so therefore investors can switch between each portfolio annually. And we keep a relatively tight discount of both portfolios. We're here to talk about the value that's on offer in the investment company sector, and we definitely think that, and the underlying portfolios, many of them trade on discounts, which we think are really good value. So we keep the overall trust close to a tight control of discounts. And actually within the income portfolio, we've been issuing shares, given that the dividend yield is roughly 6.5%. So how does the level of resource that we've got all come together? Some industry jargon here, which I'll try and get through. So strategic asset allocation, what does that mean really? Well, how do we invest on a medium-term view? How do we position the portfolios either to capture growth in the capital or generate income and grow that income over time? Investment trust selection, that really is the key part of the portfolio management. What are the holdings that we're selecting? How do we do that? That's where we spend the bulk of our time when we're managing the portfolio. But also tactical asset allocation. I referenced earlier the multi-asset team that we're part of, are constantly thinking about how can we tactically position portfolios, and these are more shorter term in nature. It could be adding to a particular region, it could be adding to a particular trust on a discount. And so it's those three pillars that come together to drive performance for the portfolios. And I said investment trust selection is where we spend the bulk of our time, and investment trusts, as James, you rightly pointed out, have multiple different stakeholders in them, not just the investment manager and what they want to do, but also corporate governance, structure and the asset class. And I'll just run through quickly each of those. So when we're looking at this, we're trying to bring lots of different qualitative aspects into one single score, and that allows us to compare and contrast between regions, geographies and asset classes. So the asset class, when we're scoring different questions, there's around 20 different questions across this whole scorecard. When we're thinking about the asset class, it's like, what is our real knowledge of the asset class, and how's that asset class behave through time? Is it very interest rate exposed, or take private equity? Is it rely on different exit cycles, or is it public equities where it's a lot more visible? The investment manager, really, when we meet with lots of different portfolio managers, and that is really the key part of our role, is meeting with different managers. And very easy to come away from a presentation and be swayed by how convincing the portfolio manager is and what an interesting investment process they have. And we try and distill that down into more layered questions. What do we think about the culture? What's the resource that's involved? And how aligned is the investment manager with the outcomes, i.e. shareholding themselves? Corporate governance, James, you talked at the start about some of the corporate governance decisions that happened in the news this week. Well, I totally agree. It's a huge part of what drives investment trust performance. And we're trying to capture these different stakeholders. So, what do we think of the board? How relevant do we think their experience is? Have we met with them? And really, how aligned are they? Do they have much skin in the games themselves? And so we try and capture that too. And then finally, not least, but the structure. What's the do the other shareholders on the register look like? Um, we hear about the different demands, be it retail demand, or is it a very institutional shareholder register? Is there a single large owner of that, but also the size and liquidity? And we try and capture all of this into a single score to compare, contrast across different asset classes and different geographies. We also use data quite extensively to make our decisions, not just in terms of each individual investment trust that we're trying to that we're looking at and trying to understand, but also from an overall portfolio level. When we put the different trusts together, what does it really look like? We use a system called Style Analytics to do a lot of this work for us, and so that sort of greens and blues up the top. We put all the portfolios together and we can understand how does the portfolio composition changed over time? Is the manager more exposed to, say, value characteristics now? We often hear from portfolio managers, we've got huge amounts of value in our portfolio. Well, we can really test that. We can test that versus the market over, say, 3 years. And then when we put all the portfolios together, how correlated are underlying these investment trusts? Are they all pointing in the same direction? Yes, one may be in Europe, one may be in US, and one may be in the UK. But if they're all very growthy in their nature, and growth as a style works well, that's going to be great. But also vice versa in the other direction. If they're all correlated in one direction, if that style is out of favour, it's likely that the performance will be out of favour too. And I think over time, what we're trying to do is just reduce some of these overlapping exposures that can happen within investment trusts. If you think about, say, UK income investment trusts, there are lots of them, but there's not so many stocks to choose when it comes to income investing to really generate income and a premium yield. And so often the underlying portfolios can be quite correlated to one another. And so over time, we're just trying to reduce those overlapping exposures that may be there and really lean into the best ideas that we see in the investment trust space. So that's a little bit on our investment process and how we're working through the portfolio. And I think over time, just one final comment on that is we think that, and it's our intention to just concentrate the number of holdings down over time, lean into who we think the best ideas in that space are, use our quantitative part of the investment process, be it data or our scorecards, and really let the underlying managers drive performance. And so we think over time, perhaps the top 10 holdings will reflect a higher percentage of NAV and hopefully generate growth or income growth for the portfolios. And how are we going to do that in investment themes? I guess we go back to the building blocks. These are perhaps more medium-term positions. So we start with technology. Now, obviously, technology and the growth of some technology businesses has been it's quite incredible over the last few years. And you often hear questions that, is this a bubble, or how far can this grow, and how concentrated the S&P can grow? Well, actually, if you step back, those businesses that have driven a lot of that growth, their earnings have grown by a significant portion too. Yes, there's been a moderate amount of re-rating in that earnings, but really, investors have been waiting for that fade to come. When do these businesses start to look like the rest of the S&P again? And we're still not quite seeing that. And in fact, huge amounts of spend is going into AI and AI infrastructure rollout currently. And so actually, we don't think there's that fade is coming just yet. And so we've been adding to technology trusts within the portfolios. And how we've done that within the growth shares, we've been adding to Polar Capital Technology, but in the income shares, more global income type strategies such as JP Morgan, Global Growth and Income. Emerging markets, we've been adding to throughout the year. So within emerging markets, there's been a softer dollar movement this year, and we'll see how that plays out. But if we just take a step back, emerging markets, or say the MSCI Emerging Markets Index, have not grown earnings per share over 10 years until this year. So it's really been a sort of lost decade for emerging markets. So we've been adding to that. We see some of the investor flows going back into emerging markets, and some real self-help stories within some of the large technology businesses there, buying huge amounts of their own stock back and driving sort of earnings per share that way. not least some of these technology businesses in emerging markets, particularly China, benefiting from the same AI drive as perhaps the US market. And private equity, we're highly constructive on private equity at the moment, as the management of Blackstone speaking last night, as highlighted by Deutsche Numis this morning, just saying how really private equity markets are starting to pick up, deal flow is starting to pick up. And when you see deals start to pick up within private equity, that's when you tended or historically tended to get these valuation moves. And it's as they're selling the deals, they're a carrying value, and if they can achieve a premium, that's when you see the NAV start to move. And we're starting to see that, I think, over the last few weeks. Oakley Capital, which I'll come back to a bit later, has been able to realise some assets all year. HG Capital announcing a deal recently in ICG Enterprise overnight, its largest holding being sold. So that deal flow is really starting to pick up in private equity, and so we're quite constructive on that as a sort of theme or sub-asset class at the moment. And finally, alternatives. Alternatives, huge bucket. You've captured a couple of them, James, at the start of this, I guess in Bluefield. But we've been adding and introducing some new investment trusts to the portfolios. And alternatives, obviously, you've got the infrastructure, property. Really, what we've been trying to add to is that digital infrastructure portion of the investment trust market. Pantheon infrastructure across both the growth and income shares, and Cordiant's digital infrastructure within the just the income shares. And we really think that that's when we're talking about that growth in AI, you don't always have to just pick the winners, like say a Polar Capital may do from AI, but really that old adage of the California gold rush is that picks and shovels can drive a lot of performance too. And it's better to be selling the picks and shovels. And if we think about Pantheon and Cordiant as benefiting from the infrastructure rollout, and then that's areas that we've been adding to within both sets of the portfolios. So just some transactions really since we became portfolio managers at the 1st of June. I've talked about Cordiant digital infrastructure. I'll just go into a little bit more detail. It's really a European focused build out model, buying businesses, building and growing the value of the businesses. And why is it a candidate for the income portfolio? Well, it pays around 4.5p dividend, which is roughly 4.5% dividend yield currently. But it's able to earn, its cash flows are much greater than that. But instead of just paying it all out to us as shareholders, which you may get in some of the core infrastructure or debt funds, they're using the surplus cash flow to really grow the value of the business by investing in new areas, data centers, more networks, or more fiber rollout, as some of the underlying businesses can do. And so that's really think what we're trying to achieve here in the income portfolio is not necessarily just income today, but also grow that income over the medium term. Pantheon infrastructure, I'm talking about infrastructure a lot here, but Pantheon infrastructure, a little bit different, maybe similar names, but a bit different. Invest more private equity type approach, invest in top tier private equity managers, specific deals. So it's only got 13 or soon to be 14 assets with a new deal that it's got. And the proof is in the pudding with private equity. It's announced its first asset sale. It doesn't control that asset sale. It is the private equity manager that does. But Calpine invested in 2022, already more than double the return on that through the deal that was announced earlier this year. So. So pretty comfortable with both of those. James, you talked at the start about 24 Income Fund with its share issuance this year. We've owned 24 Income across different mandates, which we're part of since IPO, actually, since 2013. We know the team extremely well. So we bought the fund before the issuance this year as a new holding. Obviously, structured credit, bit of a dirty word post 2008, but this is a very different model now, but European focused, cash flows backed by mortgages and corporates. And we see it as a little bit of a hedge to some of the other value areas of the portfolio in that the bonds are floating rate. So it benefits if interest rates stay higher for longer in a way. Whereas much of the infrastructure has been very interest rate sensitive and has actually performed poorly as interest rates have stayed higher for longer. So yeah, very comfortable with 24 Income Fund there too. GCP infrastructure, it's again that infrastructure point. It's got a 10% dividend yield, but it's debt focused rather than say the Bluefield example earlier, which obviously owns the assets. And not only is it debt focused, it's been able to pay down its revolving credit facility almost since around about 18 months ago. And it's still trying to realize more cash flow and give that back to shareholders. What have we been selling to fund all of these new acquisitions? UK equities. Now, UK equities has performed reasonably quite strongly this year, particularly up the cap scale, some of the mega caps. So we've just been trimming some of those holdings to free up some capital to really buy some new assets and think more globally around the CT Global Managed Portfolio Trust. If we think about the shape of the market, it's really been those larger mega caps that we've been trying to sell on the investment trusts, or those focused up the cap scale. And we think more of the value is in those small and medium-sized businesses in the UK trading at sort of generationally low valuations. Meanwhile, private equity continues to take out different UK M&A targets. And then speaking of M&A targets, Apex Global Alpha was taken from us through the Ares transaction now. We spoke to the board and thinking about that corporate governance angle, had a really good chat with the chair on that before we sold the trust, which has been now taken out from the investment trust market. But it was taken out around about 17% discount, which on the surface is obviously a discount to NAV. But from guessing where the share price was, which was around a 40% discount earlier in the year, it was an uplift. I've talked about Pantheon Infrastructure already. I don't necessarily need to go into it too much. Talked about the Calpine asset. It's recently added to the FTSE 250, but it's now 1.5% of both the growth and income shares. And I think, why do we want to own it across both portfolios? Well, we think about it as more just private equity, but in the infrastructure world. And we think that it's a candidate because some of the real uplifts that it can achieve through its private equity approach. Through Calpine, you can see that 2.3 times return since just July 2022. So we think there really some latent growth in that. But also the income portfolio. Why have we bought it an income portfolio? Well, it was paying an uncovered dividend to begin with. It was just ultimately giving shareholders their cash back. This deal, excuse me, this deal has allowed them to be able to really generate some cash and start to cover the dividend or get much closer to cover their dividend. So if we can receive 4p or around 4.5% from the asset, at the same time grow our valuation, we think it's a really good candidate for both. And then within the growth shares of the CT Global Managed Portfolio Trust additions, we've almost doubled the weighting in Oakley Capital Investments with private equity. Oops, you have to excuse, it says infrastructure here. They're definitely not infrastructure. Private equity focused, really partnering with entrepreneurs around Europe, and I'll come back to that. But we've almost doubled the weight there, so we've included it in this additions point. Pantheon Infrastructure I've covered already. JP Morgan Global Growth and Income. It's a new holding in the growth shares. It's already held in the income shares. And why would we want to do that? The managers at JP Morgan think of it as a global growth portfolio. They're not necessarily aiming for yield. It really is the best ideas. They see it as one of their best ideas portfolios across the company within the global space. But it's the investment trust structure that makes it more of that income. It's that 4% capital linked dividend or thereabouts. That makes it that global income approach, but it really is invested in, say, lots of sort of US growth businesses as well, but with a quality focus. But obviously to fund some of these acquisitions that we've been making, we sold Lowland Investment Company from the growth shares. Now that it's got a lot of respect for Laura and James at Janus Henderson, and we still invest with them on the income shares, but that is trying to generate natural income, and so the universe does shrink a little bit for them to do that. We've got lots of good UK small cap ideas, and so we've just used that to fund some others, and we still invested with them in Lord Venture, which is more up the cap scale too. And then Finsbury Growth and Income, Lindsell Train managed UK fund. Now, we has a very distinct quality bias. We've invested with Lindsell Train over a number of years, or previously invested with them over a number of years, and that quality factor that they really represent we think we can achieve that in more global, more unconstrained, not constrained necessarily just by sort of UK and a few and some other holdings. So we've just turned that to be a bit more global in nature. And then finally, final slide from me, and happy to take lots of questions on anything I've just talked about. Oakley Capital Investments, it's a bit of a case study. Definitely not infrastructure, definitely private equity. They partner and invest with entrepreneurs around Europe. It's got a very strong long-term track record, yet still trades around 25% discount to net asset value. Talked about how difficult it's been for private equity to exit some of the holdings over the last few years. They haven't been so reliant on that. They announced a sale of a holding at a 300% premium to their carrying value early this year. Now, that is not a read across to the rest of the portfolio, but does speak to when you have when you have unique assets that companies want to acquire or invest with, when you get that competitive bidding process, what you can really achieve. They've announced another sale recently, and an investment in a paddle business, which is very on trend at the moment, but I'm not so good at paddle, so I won't be benefiting from that. But it's now our largest single holding in the growth portfolio, just under 6%. We think there's lots of pent-up value in the private equity sector, and we think Oakley Capital are best to capture that for us. So hopefully an overview of not just the investment process that we use now with the investment trust, but also some of the positioning changes. And I think the last thing I'd like to just leave listeners or watchers with is that we just expect that top 10 to really represent more of our best ideas going forward. There's a slight transition in terms of how we get there over the coming months, but really that top 10, if we can get that to really drive some of the performance for the investment trust, then that's the job we're trying to achieve.
Brilliant. Thank you very much, Adam. Really interesting. And, we love our Oakley, we love our patented infrastructure. All these things are ticking the boxes from the quoted data point of view, which is good stuff. Now, where should we go with this? So, firstly, I think, just thinking about the sort of big picture, are there sectors and countries maybe where you'd like to have more exposure, but there just isn't an opportunity to invest in it through investment trusts?
Yeah, very good question. I would say that probably the most underrepresentative area versus, say, global markets is the US.
Mm-hmm.
Very few US trusts that I know there are some, and there's some with income focus too. And as part of our review of the sector, we'll consider everything. But if you think about the number of UK trusts there are versus UK all companies and UK income trusts, that's sort of really at odds with what goes on in world markets. And we want the global managed portfolio trust to be exactly that, the global in its approach. And there is quite a heavy UK component of the overall sector. And so, yeah, I would say it's the US, which is a little bit underrepresented on that respect. I think there's lots of choice for investors in other parts of the market. Lots of choice in infrastructure and alternatives, lots of choice around, say, private equity as well, although shrinking a little bit perhaps. But so yeah, I would say US equities would be the one area, but there's still lots of value in other areas. So that's what we're trying to do.
Fair enough. And I think people would be keen to know what your view is of US markets. And when there's specific questions around, is AI a bubble? But I think that markets have been driven by these big US mega cap AI plays. Do you think that the valuations are looking to stretch and you want to have a sort of underweight exposure to that now, or is it too early for that?
I would say there's a famous investor, Mark Andreessen, who recently said that every year you get some of technology being called a bubble. Now, and he's sort of highlighted an article over the last 20 years of when that's the case. I would say valuations in the US, particularly around technology names, can be optically look quite full in that higher versus history. But I think you've got to think about some of the earnings growth in these businesses. And we haven't necessarily seen like a dramatic re-rating, a moderate re-rating for sure. But when the earnings growth has been so strong, then maybe some of that valuation premium is warranted. The specific question around bubble. Now, there will always be when you get huge build outs of different areas through time. There will always be pockets which run extremely hard and capture investor imagination. I'm not invest and wouldn't recommend this anything PA, but I mean you may have saw this week, but Beyond Meat, which was like a growth darling in 2020, and then like fell off a cliff in terms of share price and earnings perspective, and then it was up like 1,000% this week, and then down a lot. Now there will always be pockets of this speculative activity, but I think if you think about that core US technology mega cap market, that they are not that egregiously valued. Yes, valuations look a bit full, but they're still growing earnings, cash flow, high margins quite strongly. And I think, as I said earlier in the presentation, investors tend to wait for that fade of earnings, just not happening just yet. So yeah, we're comfortable adding to the area rather than reducing it right now.
Okay, great, thank you. One of the things that we are maybe seeing is a bit more US interest rate cuts. Does that make a difference to anything you're doing?
I would I wouldn't say the sort of Federal Reserve interest rate cut specifically, but they do tend to lead and drag other central banks with them. I would say more specific for the investment trust market is the Bank of England, given how many of these alternative asset classes are priced with long dated cash flows, so it can be quite sensitive to long-term bond yields. And from our own research as a multi-asset team, we see actually a little bit constructive when it comes to UK inflation, which is maybe at odds with what you read in the press a lot. But we just see a slightly downward pressure on inflation, perhaps versus market pricing, and that should be if you've got central bank, if you've got the Federal Reserve beginning to cut interest rates, you've got say energy prices which are high in the UK but not growing so much now, and slightly downward pressure. That tends to have quite a strong feeding to the UK economy. And one of my colleagues says the sort of tagline when it comes to UK inflation at the moment is the UK is not an island when it comes to this stuff. The UK is part of the global system, and if we're getting global slight downward pressures on inflation, then the UK will participate, albeit from a relatively high starting point now. And I think we've yet to see it, but I guess the real elephant, for want of a better phrase, elephant in the room really is what is the effect of technology going to have on inflation, and if you are able to produce work or replace labour ultimately at a lower cost of production, what does that do for global inflation? And results yet to be seen there, but it's just sort of something we're thinking about.
Yeah, definitely. It's interesting stuff. How much of the portfolio is exposed to that kind of technology theme?
So direct technology holdings within the growth shares, we've got both Polar Capital and Allianz Technology. So I would say that's roughly 9.5% of the growth. So if you think of that as sort of core technology, on a look-through basis, how we think about it more increasingly, a lot more. So within the growth shares, position in Scottish Mortgage, JP Morgan Global Growth and Income. So they would be sort of obvious technology faced investment trusts, as well as Schiehallion Investment Trust, which is in the private space. If you add in the likes of HD Capital examples, for example, then lots. But technology makes up a lot of the investment gains, and we still think continue to make up a lot of the investment gains. Now we obviously have other areas of the portfolio which are perhaps more value in their nature, Europe and UK. So we're not just exactly pointing in that one direction. In terms of the income portfolio, it's harder to capture those technology businesses, given many of them don't have an income, or trusts don't have a high income. So we see that as we're able to plug some of that gap, perhaps with some of the alternatives exposure, Pantheon, Cordiant, those benefiting, we think, from big technology spend from either corporates and governments. So yeah, so slightly different answer for both growth and income shares, but increasingly we're increasingly trying to add it rather than reduce it.
Okay, fair enough. Thank you. What about biotech and healthcare? I mentioned that earlier on as the sector might be unloved. Is that something that you adding to or hold or?
Yeah, we hold a number of healthcare related names. You're right. I mean, some of the returns, say since April, have been quite tremendous in some of the biotech and much smaller companies. Um, I would say on a 3 to 5 year view, where we're seeing some of the recovery now, um, but as we've seen, they can be very challenged by
Mm.
movements in interest rates. So yes, we can talk about how some of the renewable names are challenged by interest rates, but in a higher cost of capital environment, that can be quite challenging for a biotech businesses that requires capital to come into it to fund it. So I think overall we're a little bit more sanguine. We're sort of sanguine for now on the area, and we're happy to recovering. But on a maybe 3 to 5 year view, we'll probably let some of our global best idea managers make those allocations for us than necessarily have dedicated strategies, although we still remain in them today.
Um, Within emerging markets, because it's quite sort of like germane to what we're doing next week. Um, do you favour India or China?
Um, Well, so when we're adding to emerging markets, we're looking at managers to ultimately make those allocation calls for us, and that rather than say, right, we want to allocate China to China or India. I would say, so we're not necessarily using the China Trust or an Indian trust to do that. Within India and China at the moment, it's been quite, I mean, it's just sort of the real jaws of performance, hadn't it been, up until the start of this year for India growth and Chinese uh, performance, and that's reversed dramatically this year. I think the AIC China sector is up like 38% or something, isn't it? And only behind gold or resources sector. And when it comes to innovation, we see a lot of it in China. We see some of the breakthrough moment earlier this year with DeepSeek. Now that maybe DeepSeek doesn't necessarily challenge Nvidia in terms of sort of dominance of the market, but it is representative of the amount of innovation that still goes on in China. So I would say in the round, we want to be exposed to some of these Chinese businesses, which are still at the forefront of some of these technology drivers, but on really quite cheap multiples, and probably appropriately so, given uh, um, some of the governance reasons around them. I would say within China, there's a lot of self-help going on, buying back huge amounts of shares. So we see that's constructive.
Cool. When you think about UK exposure, have you got any worries about the budget, or you think that's a maybe a non-event for your fund?
I think everyone's got worries about the budget, haven't they?
Personally, maybe. Yeah.
Well, just it's the unknown's never good for investment, right?
Yeah.
So I would say, yeah, the uncertainty around it probably puts businesses off, probably puts business investment off. Um, I would say where not necessarily the budget around the UK as a multi-asset team. I won't spend too much time on this, but we think about fundamentals in terms of how the backdrop is. We think about valuations, what's in the price, but increasingly spend more and more time thinking about behaviorals. And what does behaviorals mean? Flows, positioning, and the flows over the last, say, 10 years in the UK have been quite dreadful and actually don't really show signs of slowing dramatically right now. So that's that area that keeps us a little bit more off the UK, and with uncertainty around the budget, that doesn't look like it's changing just yet. Now, maybe you get a relief rally post a good budget. I'm not too sure. I wouldn't be the right person to ask there. But if we see positioning start to change in UK, that will make us more constructive.
Um, Private equity. I mean, I keep banging on and on about I don't understand the discounts,
Good.
but would you still want to hold all these things if they were trading at asset value because of the NAV upside, or is it more of a discount play for you?
Very good question. It's certainly both at the moment, and I think there are, if we want to hold them at asset value, I think our allocation would rightly shrink as a result of that. And we'd be at the moment, we're focused on both what we think the underlying portfolio can deliver, as well as a pull to some sort of value, par, not necessarily par on NAV, but a sort of long-term average to be able to generate our returns. So that's why we're really constructive on it now. I think if say all investment trusts, all private equity investment trusts were trading at NAV, we would be very selective. I still think we'd want to own them if you look at long-term trusts. I'm not saying this would be the one, but HG Capital, it's not been a premium discount that's necessarily driven that performance over the 10, 15 years. It's been earnings growth and underlying NAV growth. And so we still want some of that, but we'd probably be even more selective than we are today.
Yeah, that makes sense. What about renewable energy? Because obviously we're talking about Bluefield and the things that are facing these sectors in terms of they want to invest, but they haven't got the money to do it. And there's sort of threats to income that might mean. What's your kind of take on whether that's a good place to be now?
So we don't own any of the solar vehicles, and I've never, myself and Paul have never owned the solar vehicles. We have some of the wind renewable assets, with a preference towards UK wind there, which is a little bit more equity-like in its characteristics. We obviously own GCP infrastructure, which is more debt focused, so not necessarily requiring lots of capital that go into the. But I think you're right. I think you're very right to pick out the challenges associated with almost like a capital constrained business in something that's cash hungry, and that can be within alternatives. That could be in many different areas. Could be more private equity like assets, or it could be other areas of the market where. And so we're just we're when I think you can look at these investment trusts and think, well, great dividend yield, but if you have a capital erosion over time, then really, how are you going to realize that value, and how true is that discount if the valuation is coming down? And there's been a number of deals in the last few months, particularly with renewables, where some of the prices paid for the assets are way below net asset value. So it's almost like an optical discount at points. So it's not necessarily adding fresh amounts of capital to. As I said, we've got some of the wind renewable assets, which are perhaps in more I want to say trophy-like assets, but areas which may attract deeper pools of capital than say solar in the UK.
Yeah, I take your point about the selling things at a discount. I think Aquila just announced a deal today to sell some stuff to its related parties at a double-digit discount to NAV, which is it doesn't look good. All right, we've covered a lot of ground. There's a question about gearing. How do you use gearing within the portfolios?
So we have a revolving credit facility. It's currently deployed on the income portfolios. That's sort of unchanged over the past year or two. There were some loan notes, or a loan note in the which rolled off the start of this year, or close to the start of this year. So currently it's an RCF facility, and in income shares it's deployed just under 10% of the value, so moderately geared. I guess a sort of side question is, could that be used on the growth portfolio? And they're quite a long duration, we think, in the growth portfolio in terms of the equity like. So we still think we can grow value through that over time anyway. So
cool. And then just to finish up, because people always want to know, are you an investor in the fund?
Yes, become an investor as we took on the trust start June this year.
Very good, very good. Well, good luck with it all. I mean, obviously you've got big shoes to fill.
That's why it takes two of us, James, to do it.
but I do envy you a bit, because it's a fun job, I think, running a fund investment companies. So
yeah, I mean, we're definitely fun and passionate about the sector as well. So the sector has come under a challenge over the last few years, and I think there's some great value on offer, and the investment trust sector has got a lot to be proud about. So we feel particularly privileged to be stepping further. We've invested in the sector for 15 years, but privileged to be stepping further in at this point in time.
Brilliant. Thank you very much, Adam. So
thank you,
good
James.
luck with it all, and we'll get you back again, see how it goes.
Look forward to it.
Good. So we will be back next week, and I'll do the news as normal, so live. But the actual panel that we've got, which is China versus India, we're going to pre-record, because just the timing of James is in Singapore, and so it's just a bit awkward to do it that way. So we're going to pre-record it. So obviously we do want to get your questions still. So please, can you email them to me? And if you get that done by Monday, then I will be able to put them to them when we do the pre-record, and then we'll broadcast it after we've done the news show next Friday. So have a good weekend. Thank you for listening to me, and good luck with everything. Goodbye.